Hey, what's going on, guys? EBS Invest here, coming back with another video. Today we're looking at the ticker MSFT, also known as Microsoft. Microsoft provides consulting and product solution for companies and services. They offer cloud-based and software-based services for consumers as well as corporations. Microsoft is the second biggest holding in the S&P 500, looking at a market cap of $2.16 trillion, and you are looking at an overall stock price of $287, a 287,000% increase, which is pretty dang good. You can see Microsoft had a nice run up here um, through this time, and then got really stagnant up until the Great Recession. It was down a lot, and people like to think of IBM as the new Microsoft because IBM's getting trading sideways. Um, this was a Bill Gates child. Then the Bill Gates child was growing up and having some teenage issues and had to figure out what it wanted to do in its life. And Microsoft just went all in on cloud. And that cloud, that definitely paid off. You can see ever since, let's just pick right here, it's up 922%. So, um, Microsoft is one of the biggest cloud providers. Their cloud is called Azure. Their main competitors are IBM Cloud and AWS cloud services. But Microsoft is like one of the Mac daddies for the stock market. You know, I'm sure you guys use maybe some of their services and software such as Microsoft 365, Outlook, PowerPoint, etc. But overall, if you haven't heard of Microsoft, you're probably living under a rock. But hey, this video will help you understand a little bit more of what they do. We're going to go over here to the track your dividends page. So I'm using a free trial for this analysis. I just figured I'd give it a shot. So if you guys like this, I think it'll definitely help with the content because it just gives us another place to base our bets off of, as well as some pretty good numbers. So you can see you're looking at 17 years of dividend increase, a 26% payout ratio, which is very healthy, $2.4 annual payout, and a 0.86% dividend yield. So I do like they will be a dividend aristocrat as long as they keep increasing their dividend, which I think they probably will. You can see overall that their stock price, like I said before, is doing pretty well. Coming down to the dividend payments, you can see that they have obviously this, if you were to draw a line straight through the middle, it'd be going straight up pretty well. You can see they pay 62 cents a quarter per share, and about 10 years ago, you're looking at about 23 cents. So they've almost 3 times the amount that they pay in dividends. You can see they get an overall dividend score of 87. We'll go over the other scores later on. You can see they have a trailing EPS of 8.9, not too bad. You can see they have a high PE ratio that does concern me. I don't think you should have to overpay for growth, but this is one of the best companies in the world, so you have to really base yourself on that moat as well as that possibility for high growth here. You see they have a little bit higher beta. Overall, they have a high average market volume, but let's go over and let's check out the charts page because I think we should check that out. You can see they have a pretty good profit margin. You're looking at 37% net profit, which is pretty dang good. You can see they have been increasing. Well, they had a nice run up on their return on equity. Came down a little bit right when I said they're having that stagnation, and now since they've been all in on cloud, they've been doing pretty well. Although that green bar hasn't caught up, but it is increasing pretty well. Going down to earnings, you can see their earnings and revenue have increased very well over the years. It's like a straight line almost. And going to their cash flow is almost the same thing. You can see they've been increasing their cash flow. Their operating cash flow and free cash flow has been increasing as well. So I think that's very good to see that their cash flow is following their earnings. You can see they do have some debt, not too bad. Their current ratio is down. But I do think it is good that we have a very high net profit margin, as well as you can see that we're increasing that return on equity. We're also increasing that cash flow, and we're increasing our revenue. So I think that's all very good things to see. Going over to the dividends page, you can see they get that 87 score like I was talking about. You can see that they have a very good payout ratio, good trends, good dividend yield, and good growth. You can see that a 10% increase back in December. They pay a quarterly dividend. And overall, you can see that the dividend tracks pretty well to the payout ratio. We had a little bit of influx here in 2015 and 2018, but it looks to be ever since 2019 we've been tracking it pretty well. We already talked about the dividend payments. Let's go over and let's talk about some of Microsoft's competitors. So you can see if you want a very good dividend score as well as a company that's cemented itself in the market, I always tell people if you want cloud, just buy Microsoft because they have one of the best safety scores. If you want a higher dividend yield, you're getting closer to retirement, you also want that cloud and growth aspects, I'd probably pick IBM. It's surprisingly though that they don't have Amazon listed here because AWS is, you know, a big competitor for them. But you can see the rest of the competitors are centered in here. You have Apple down here, Oracle, SAP, Cisco, and HPQ. So overall, I think out of all these, Microsoft looks to be pretty good, but it does offer a little bit lower yield, so that is something to be aware about. Let's go to the valuation page. You can see they give Microsoft a value of $425. I think that is a little high, but we'll have to go over into our spreadsheet and figure out if that's actually a good price to pay. You can see they have a very good discounted cash flow. They have an okay return on assets, good return on price to equity, good return on equity, good debt to equity, and good price to book. So overall, it looks to be that the ratio scores are pretty good. So I think Microsoft, at least on this valuation, looks to be like it's pretty darn good. Going over to the analysis page, you can see that they would rate Microsoft as a strong buy to buy, and I would tend to agree with that, but like I said, we'll go over to our spreadsheet and check it out. I'd also just like to talk about for a minute, their payout ratio is very low. What does that mean? Only 26% of their free cash flow is actually going to paying a dividend, so they're able to double this right now, and they would still be moderate, they'd still be healthy. So I think that's good. Their dividend payment is low. They have been increasing it as well as offer low yield. So if this stock is in our buy price, I think you'll have a great stock set up for the future. For when it stops growing, you're going to get a nice dividend and they'll just pay you to hold it. Going over into our spreadsheet here, I applied a 1.8% 2G because I have a little bit more of a moat, an 11% growth rate. Yahoo had it at 15 and 20%. I think that's just a little bit too big. You're looking at a $2.1 trillion company. If they were to grow at 20% a year, they'd be well over $10 trillion in a few years. So I just think that that's just a little bit too much. I do think that we should maybe potentially drop this to like a 9% growth rate. But you can kind of play around with what you think, but maybe a 10% growth rate is fine. So I get an intrinsic value of 277. So I would say that's overvalued, but comparing it to the track your dividends page as well as mine, you're going to get an average price of 351. So I would have to say I would rate this company as a buy, but make sure that this company fits your portfolio and your needs. Also, just make sure that you understand the company and the business model. And also, do you believe that cloud and software services are going to increase over the next 20 years? I personally think so. I would rate Microsoft as a buy, but I would dollar cost average into this company. It's not often that it goes on sale. Like I said, looking at that chart, you can see, at least on the 5 year, it doesn't really go on sale that often. You had the COVID bubble, and now here you had like this nice little sell off. So I think you still have some room to get in if you want to secure yourself a little gain. But I do think that it is closer, probably closer to that $300 mark. But looking at, you can see that we have a buy price of $281. Microsoft is currently trading at $287. So maybe put a little hold on it, maybe set a limit trade, but you could also just dollar cost average into this stock, and I think you should be all right. Remember, this is not investment advice, this is just purely educational purpose. I'd just like thank everyone for watching it to the end of the video. If you like my content, please drop a like and please drop a sub. It really helps me out as a small YouTuber trying to grow. I really do need that help and that footing. I really do appreciate every one of you guys. If you like Microsoft, leave it in the comments below. If you don't, leave it in the comments below. I'd love to hear your guys' thoughts and analysis. This has been EBS Invest. Thanks for watching. See ya. Peace.